All right, so thank you for being with us this afternoon. We just had a great discussion on the challenges of risk protection in retirement, and we're going to turn the discussion, the focus on this panel more squarely to retirement savings and what individuals are doing and can doing to save for their retirement. And in particular, we're going to focus on the policy landscape of retirement savings accounts. So the conversation of this panel is going to focus on a paper that the Hamilton Project commissioned from John Friedman of Brown University. And we're delighted he agreed to write this paper for us. And what John proposes doing is reforming the landscape of retirement savings accounts to make it easier for Americans to save and ultimately to increase the amount of retirement savings that people accumulate. I'll first introduce John, and then I'll introduce the rest of our panel before I call John up to describe in more detail his proposal. So John is an associate professor of economics and public policy at Brown University. He previously was on the faculty of the Kennedy School of Government at Harvard and served as special assistant to the president for economic policy within the National Economic Council at the White House. And we are privileged to be joined by two very expert panelists to talk about John's proposal and the broader landscape of challenges. Frankly, I can't think of two individuals better suited to comment on this set of issues and this proposal. So Debra Whitman is AARP's Chief Public Policy Officer, and AARP, of course, is our nation's leading advocacy organization for individuals 50 and older. Debra leads policy development, analysis, and research for the organization. She's an authority on aging issues, and she has extensive experience in national policy making and the political process. To my left is James Poterba, the Mitsu Professor of Economics at MIT and the President of the National Bureau of Economic Research. Jim is among the leading academic scholars in the nation, if not the leading academic scholar in the nation, on retirement issues and more broadly on issues of taxation and public finance. Jim is also a trustee of the College Retirement Equity Fund, the TIAA-CREF Mutual Fund, and the Alfred P. Sloan Foundation. And so I thank our panelists for being with us this afternoon, and I look forward to a great conversation about these issues. So now I'll invite John up to the podium to give us an opening overview of his proposal, and then we'll move into the roundtable discussion.
Great. Well, thanks, Melissa, and it's a pleasure to be here. Thank all of you for taking the time to share in this conversation with us today. So Secretary Perez, opening the day, I think gave a great overview of why retirement savings is such a critical challenge for us in our nation today. Workers are living longer than they ever were before. They're leading not just longer but costlier lives in retirement. And the traditional sources of retirement income, such as Social Security and defined benefit pension plans, have been receding over time. And so all of that places more emphasis on individuals themselves to be responsible for the savings than ever in the past. Now, where I'll expand on what Secretary Perez said this morning is that I think that leads to two particular challenges that I've tried to think about in this proposal. The first one is that in order to let people save, you have to give them a savings account to save in, and too many people don't have easy access. So, of course, anyone can go open an IRA, but the most convenient way to save is through a workplace savings account, and only about 40% of people have access to a workplace savings account with all the convenience and benefits like payroll deduction that it affords. And that is a problem that is especially bad for employees that are at smaller firms where it's just harder for them to mount this service for their workers, even if they think it would be something that's valuable. The second thing is that we primarily try to encourage people to save by giving them tax incentives to do so. It's a great deal to contribute to your retirement fund as opposed to saving in a taxable account. But those tax incentives are kind of misaligned in two key ways. The first thing is research suggests that they're not that effective at encouraging people to save. And second of all, they end up providing the most benefit for the people who in fact least need it at the end of the day, which is those people who are already saving quite a bit for retirement. And so what this proposal is aiming to do is to reshift this to provide, especially for the middle class who they can't rely solely on Social Security when they retire, a better way to have access to retirement savings and to accumulate the wealth that they need in order to live financially secure lives in retirement. So my proposal has two key elements to it. The first is a simplification proposal that we should take all the various different types of retirement accounts and consolidate them into a single universal retirement savings account that would follow a worker throughout his or her life, could accept contributions from any source, and would feature protections very much like those in 401ks today. And as part of that, the idea is to relocate some of those plan costs away from the firms that currently bear them to account managing firms or financial firms that are kind of designed to deal with this type of thing. Second, the idea is to offer firms large tax credits. So it's about $1,000 a worker for small firms, and that adds up to something like $22 billion a year, so this is quite a bit of money, in order to help their workers save for retirement. It's a very simple credit where it's just you get an amount for every worker in your firm that's saving, and I pay for that by taking a little bit off the top of the existing retirement savings incentives through the tax code, with the idea that we're replacing a system that's less effective at encouraging retirement savings with one that's more effective at encouraging retirement savings. So these two proposals, when combined, would result in a number of benefits for workers. First, there would be a large increase in participation. So I project that participation would increase from about 40%, which is what it is today, up to somewhere in the 60s, maybe in 70% if you a little bit more optimistic. And those effects are the largest for workers at small firms, where coverage rates can be, I think it's like 13% for firms with fewer than 10 workers right now. Simplification is also a major benefit. This is not only about reducing hassle, but it's about improving decision making. Evidence suggests that when you're trying to make decisions about how you save in your retirement and your savings are spread across 10 different accounts, that is not an environment that fosters good decision making. Consolidating will help people make better decisions about their retirement savings. And it also will help reduce pre-retirement leakage, which is an increasing problem in the US. People may get money into their savings accounts, but it comes out before they retire and it's not there for when they need it in their retirement. New tax incentives also provide more benefits to the middle class, so there's an increase from about a third to maybe 43, 45% of benefit from the tax expenditure that goes to the middle class as opposed to the top 20%. I think this proposal would also have a number of benefits for employers, which play a critical role in the savings system today and would continue to do so under my proposal. First, we benefit firms directly from helping their workers save, so it takes something that sometimes just we understand a small business owner has a lot of things to worry about. This might not be the first item on their list, but it kind of raises the profile and makes it really something to pay attention to. The tax credit is large enough to overcome the startup costs and to kind of any, not just actual, but perceived startup costs, and to really make it something that small businesses couldn't afford to not take up. Second, it reduces the cost of providing access for workers, for firms, even aside from the tax credit. So instead of having to take on, for instance, the fiduciary responsibility that the Secretary talked about earlier today, I relocate that to the financial firms, which I think is just a more sensible place to put it. It's important that we have those protections, but we don't ask employers to help workers find the right mortgage or get the right credit card. I think in the same way, we shouldn't ask firms to make sure workers are invested sensibly for retirement. And third, employers play a key role in helping to tailor the offerings for workers in their particular situations. So this is an advantage of having the employer as opposed to just having this as a blanket national program. The national parameters provide bounds, but firms can help figure out which workers should be saving more, which workers can be saving less, and help make sure the policy is best suited to each worker. So with that, let me turn to the panel, and I'm excited to hear the discussion.
Great. Thank you, John. So I'm going to open this up with just opening questions to both of you, Jim and Debra. So Jim, what do you think should be the main goal of reform in the retirement savings space, and how would you go about achieving it?
Well, I think, Melissa, there is much to be applauded in the way John has focused on the expansion of coverage in this proposal. I think we have a lot of evidence that employer-sponsored plans make it easier for workers to save. We've had great experience with the use of defaults in some of those plans in the last 15 years as a device for increasing participation, increasing the amount that's saved. Unfortunately, probably at levels that are too low. The typical default is still 3% of salary, and that, especially in a low interest rate environment, That's just not enough to be able to deliver meaningful retirement saving for many workers, given the available length of their careers. But John, as John noted, the coverage rates of retirement plans, DC plans, drops off as you move down the size distribution of firms. So, we're very high participation rates and very high availability rates at the largest firms, in the range of 85 to 90% for firms, say, that are, 500 or 1,000 workers or more. But this is much lower numbers, half that, and sometimes lower when you get down to less than 50 employees. So I think trying to figure out ways to push the employer-sponsored plan further down in the size distribution of firms is very much something we should be thinking about. At the same time, we should be trying to make these plans simpler, both for the employer as well as for the worker. We should be facilitating portability to move from one employer to the other. And we should be trying to, bottle up the leakage that comes out of the system before retirement. That's a tricky issue because if you make it harder to get the money out, people may not put it in the first place. But thinking about ways to keep that money around and support retirement as opposed to earlier consumption seems important. The place where I think it gets trickier is on the financing side of what John lays out. I fear that the new set of credits for firms may actually be viewed as a new complexity by many small employers, that the experiences firms have had with other ACA-type mandates or with new sick leave mandates in some states. Small employers find these quite burdensome to comply with. So I can't really speak to the question of whether this kind of a plan will be more of a burden than a benefit, but I think it's something that's very important to try to think through. I think that trying to clarify issues around fiduciary responsibility for small employers and the simplification issues are much easier to see. The last thing, frankly, that I'm a little bit, I'm a lot less enthusiastic than John is bottling up the existing set of employer-sponsored incentives and the existing tax deductibility of contributions. Part of this, I come at this from a public finance, should we begin with an income tax or a consumption tax framework? And in a consumption tax framework, the natural benchmark to begin with is you don't tax the returns on capital. And that was, for example, in the Murley's report in the UK on tax reform, the notion that one should be operating in a, for most households at least, trying to allow tax-free accumulation as a benchmark was very much the starting point there. So that pushes toward allowing, either full deductibility on the front end or full deductibility on the back end with a Roth type account. You can do it either way and come to the same place. I think that when you go to something hybrid, and here, I'm more favorable to the savings, to the net savings effects of the current system than I think John is. I think the notion that we've got $12 trillion in DC plans and IRAs, and that all would have basically been saved were it not for these employer plans it doesn't quite work for me. And I think the fact that we, in many cases, believe that nudges and defaults tend to get people to save. We know that fact. We know that many households have virtually no financial assets other than their employer-provided plans, right? Seems to me somehow that the notion that they would have had the savings but for this is, you have to work hard to put all those things together. There is very interesting evidence, and John's one of the co-authors of this very well-known paper that looks at a Danish tax reform and finds in that case very little effect on total saving by households. And I think the question, of course, is how do we put that work into the broader tapestry of other research that we have, much of which suggests, I think, somewhat larger effects. But I think the issue that worries me about making the system more complicated in terms of the tax rules is I look back to the 1986 experience with IRAs. Pre-1986, we had universal deductible IRAs. In '86, we decided we would limit the availability of those for higher income households on just the argument that's made here, which is that those households are saving a lot, this is inframarginal, so we're probably just giving away revenue, might as well collect that revenue back and we'll still get the same savings outcome. The numbers on IRA contributors and on dollars contributed surprised everyone. We went from something on the order of 15 million contributors in 1986, when we were still in the pre-availability to everybody, to about 6.5 million contributors by 1988. Contributions went from about 38 billion to 12 billion. Now, this was not just the folks who were limited getting out of the business of contributing to their IRAs. It was actually much broader than that. So whether, and I don't think we know the full explanation of what happened, whether it was confusion, some people thought that they were no longer eligible for a fully deductible IRA, even though they were, whether it was that financial institutions did less work to push the IRA saving vehicle, but it had a bigger effect than anybody expected. I have a hunch that within the workplace saving environment, that a big part of the demand for these plans within the firm comes from those in the upper income ranks. And by the way, I mean, this is not something which is the very highest income ranks, right? I mean, for the CEOs and the really high-paid executives, this stuff is inframarginal, and we know that. But it's the higher income, but within the ranks of the firm that may be pushing for this is a valuable benefit for us. So I think there's a chance that if you start to take down the top end of that distribution and make it less attractive there, you may erode the support within the workplace for these plans. Okay, all of which just suggests that this is a more complicated problem than we might otherwise think. And it strikes me that, in thinking through where do we go as we try to make the system more efficient and to bring in greater participation, I would probably look for less expensive channels to adopt, and at the same time try to preserve more of the existing structure that we have.
So I want to follow up on 2 points that are really critical, I think, to what the position you're taking. The first, just to be clear, John lays out as one of the challenges, he thinks we're essentially wasting close to $100 billion in tax expenditures on these accounts. It sounds like you don't take that premise as a major challenge.
I think that the case is much less clear than that suggests, and there's certainly some evidence. I mean, I wouldn't point only to the work, for example, that I did with Steve Venti and David Wise in the 1980s as 401ks were getting going, but that evidence seemed to suggest that people who had eligibility for 401ks compared with those who did not, the savings in the 401k accounts was rising, the savings outside the 401k accounts was basically similar across the 2 groups. Now, there are many reasons to debate that type of evidence, right? It's not a controlled experiment. You might have different groups in the 2 kinds of firms, but at least that evidence, some work that Alex Gelber has done in the US, looking at workers who become eligible for 401ks in their firms because they've met the service requirement, it looks as though those workers tend to start contributing to the 401k. As best he can tell, there's not much evidence of a decline in their other saving, and the one thing he finds is they seem to drive older cars. So I hope there are no auto industry representatives here, but this would be consistent with they pull back a bit on some of their consumption, and they tend to move toward the saving channel at that point. So, this is, as you well know, Melissa, I mean, this is a very hard problem to crack because the data on savings are difficult. That's why the Danish information that John and his co-authors have used is so valuable. But tracking saving is difficult, and figuring out whether we really are comparing like with like as we look at these different policy changes has been very hard. But I guess I'd be a little bit less eager to, based on the evidence we have, announce that the existing system really wasn't working very well.
Okay, and one follow-up on the second part of what he's proposing then. So given that you don't think that the individual tax credit system or tax deduction system is as bad, how do you feel about shifting or maintaining an employment-based system for retirement savings?
I think the employment-based system has served us relatively well. I think that there are lots of reasons for thinking that payroll deduction in particular is an attractive way to go. And there are ways to do payroll deduction that gets away from the employer side, which essentially would use something like the FICA tax collection mechanism and then have a national system. That's a bigger debate than we're having today. But as long as we are stopping short of that, I think ways in which the employer can be used as the conduit to try to support this is very constructive. And I think that's, so I think philosophically, the way John is approaching this, which is trying to work within our structure and find ways to improve it, resonates very well with me.
Great, thank you. Okay, Debra, do you agree with John that the current landscape of retirement savings accounts need to be reformed?
Yes.
Okay, good.
How about that?
Good. And then what's your reaction to the way he's proposing to reform it?
Well, before I begin, I first have to thank the Hamilton Project and Brookings for having this important event, because retirement security is something so many of our members, including Bob Rubin, I thank you for holding up your AARP card earlier, care a great deal about. And we don't have answers for so many of these challenges, the challenges of long-term care in our last panel, the challenge of not enough people having enough to live on in retirement. And so I just wanted to give my plug for the goals of this event. I also wanted to agree with the goals of the paper, which is we need big and bold solutions to address these challenges, and that we need more people to save. Right now, and you heard the statistics earlier, and many of us have repeated them too many times, most people reaching retirement don't have enough that are going to last them for 20, 30, 40 years. Most people don't have anything, but even those that have saved really don't have enough to cover what they're going to need. And I also think that it relies on what we know about our automatic features in order to make the system easier for people. So auto-enrollment, auto-escalation, payroll deduction, how can we make a set it and forget it? And I think that's been a huge move in retirement savings, and it's really upped the amount saved by so many people. And so using those features is going to be key to any reform that we do. I also applaud the idea of simplification. Right now, there are lots of accounts. I don't know if having just one is the right definition, but what we have to do is make it easier for employers to offer plans. We have to make it easier for workers to understand if I have 5 different plans spread out over the last 5 different jobs, what is the easiest way to combine those, hopefully to get lower fees. I like the ideas around leakage. In my previous time on Capitol Hill, we helped sponsor a bill called the SEAL Act, which was Savings Enhancement by Alleviating Leakage. Time magazine called it a tortured acronym. And the best part was it was reintroduced also as the SEAL Act, but it was no longer Savings Enhancement by Alleviating Leakage. It was now Shrinking Emergency Account Losses Act. That too has not passed. But we do need to think about ways in which people are taking out the money from the system, and how can we not lose accounts, which is happening in real time, where people put money aside and may have forgotten about it from a job several times ago. So all of those things can be really helpful to our system, and so I think the paper addresses those. I also agree that the tax incentives are poorly targeted. Low-income savers get no real-time incentive to save for their retirement, and things like the Savers Credit, which is non-refundable, really don't help the lowest income saver. So we should be thinking about incentives so that people can build up real value in their accounts. So all of those, I think, are good goals. I do have some concerns a little bit, and one is really moving from our employer-based system into a great unknown. And I survived the ACA and the fights over why don't we have a single payer. So the idea of starting from scratch with a whole new system rather than looking at the system we have always just brings me back to those days when people were screaming at me on a daily basis of why can't we have a system that is different than the one it has. And I think we have the employer-based system, and because the employer-based system has ERISA and some other fiduciary responsibilities by employers, because it has non-discrimination rules that help make sure that many employers provide matches to get their workers to save. We really need to think of what are the features that are good about the current system and make sure that any new idea doesn't undermine some of those things. The employer match to me is one of the most important things, and that I worry about with this proposal, what will happen under that conditions. I also think that the proposal itself eliminated participation for people under $20,000 a year. And I think regardless of whatever system we put in place, we need to at least make it an opportunity for all people to save. Now, we can have people opt out if money is too tight and their bills are too high, but we shouldn't make that decision for them. We should make sure that the system is created for all people and that we create incentives in particular that help the low-income saver. So I'll go ahead and stop there.
But I want to ask you, because you mentioned your time on the Hill, and you do have a lot of experience in the Hill, so I want to ask you, what's your view on the political feasibility of any of this?
Again, I had some hole-in-the-dike pieces of legislation that were trying to make modest improvements to the system, and even those were hard to pass. I think proposals, and again, I went back to my traumatized years on the ACA, but going back to where we're going to totally reform a system is very, very difficult. And create a system where on a certain date everybody would have to look for their own plan, and employers would no longer have that fiduciary responsibility. I think the transition path to that would have to be well designed. And I do think a lot of employers are in the business, as Jim said, because their workers are demanding this type of help with preparing for their future. And I think that's a good thing. I do agree for small businesses, it's really, really complicated to set up the plan. And so we need things like, and there's bills in Congress that look at pooling across employers, and there are things in states that look at pooling across employers. We can talk more about that as well.
So John, I'm going to ask you to weigh in, and both Jim and Debra have emphasized that they think your framework of keeping the employer-based system is a good one. But it's a little bit hard to sort of get my head around, because in your paper you have, on the one hand, part of the problem is that retirement accounts are attached to jobs. And so as workers leave jobs, right, they have to set up new accounts and all that, and you try and get around that. But then fundamentally at the core of your proposal is we're maintaining the employer as the conduit to these accounts, right? So there's a bit of a tension there in terms of leveraging the employer, but also realizing that the fact that retirement accounts are attached to workers is part of the problem.
I agree, and I think that's a reflection of the fact that employers are not a monolithic force in retirement savings. There are some things that they do for their workers that they're very good at and we want to try to preserve. And there are other things that they do for their workers that, frankly, they're not that good at. And part of the goal of this proposal was to try to figure out at least a suggestion about how we might try to pull those pieces apart and let firms focus on the parts of this that they're good at, and kind of give them a break on some of the aspects that they're not good at. So for instance, I think that payroll deduction is a very important thing. I think that when we talk about defaults and auto enrollment, I think firms are the best place for that type of thing to happen. But on the other hand, I think that firms should not be the only way that workers can get access to what are clearly the best savings accounts, right? I don't understand what, I have a 401k, I should say a 403b with the NBER. It's a great account. Like some of it, I don't understand why that account can only be for monies that are paid as a part of my NBER compensation. Like, why can't I just contribute $2,000 to it? Why do I have to go get some wholly different thing in order to do that? Similarly, if you think about a lot of small businesses, it's not that they don't care about their workers, it's just that trying to figure out how to guide their workers through the complexities of retirement savings is not something that they're very good at, and frankly, it's not something that they should be good at, right? If you're an entrepreneur, you're trying to start up a firm, you are thinking about so many things, this need not be on the menu when there are so many other places in the world that workers can receive this advice. The point is not that we want to shrink the fiduciary responsibility. We just want to locate it in some place where, if we're asking for fiduciary responsibility for financial decisions, we should locate it in a place where firms are expert in financial decisions.
Got it. So what about, can we talk about the distributional aspects of your proposal? So you're proposing of shifting our system of individual tax breaks to the firms. How is that going to work out for workers?
Sure. So I think that the firm incentives have a couple of very nice features, which is why I tried to emphasize them. So the first thing is that I think that in all of what Jim said, there's a long literature on the extent to which individuals' incentives work versus firm incentives. I think the important point is not whether individual incentives are totally useless or not. I'm sure that they do some good, but rather whether on the margin this money is better spent on individual incentives or on firm incentives. And I think there's a lot of literature about how firms are just way more aware and responsive to this type of thing than individuals are. Now, that is not without bound, and so I've taken very seriously a bunch of the feedback that has come in both from the policy community and more informal research, for instance, following the credits for participation of small businesses in the ACA shop, right? So that was a quite complicated tax credit that had to do with a lot of different parameters. It was temporary. It was only available for small businesses. Kind of taking that lesson, I've tried to make this as simple as possible. So there's just one credit. You can take it forever. It gets smaller with, for larger firms per worker, but there are no cliffs. There are no anything like that. And all you have to do is default your workers into saving. Like, that's it. And so I agree that, in order to get firms to do this, it requires a little bit of attention, but hopefully this is designed in a way that minimizes the cost for them. And then finally, I think what we've learned from other credits, we obviously don't have a ton of experience with credits like this. There are some small ones, but other credits that are worker-based credits for firms seem to flow through and benefit primarily workers at the end of the day. And so what that means is that if I pay a small business $1,000 for helping that worker save, something like $800 of that is going to be passed back to the worker in higher compensation. It could be additional contributions to the retirement account. It could be higher wages. But I think this takes a tax incentive, which is currently a per dollar saved incentive. And so, of course, the richer individuals, richer households that save more, both get more of the tax incentives because they're saving more, and also they have a higher tax rate to deduct it from. And it reshapes it on really just a constant amount per worker, which is going to redistribute a bunch of that from the upper income households to more middle class households.
Okay, I'm gonna run with that and take a step back, and I'll throw this out to any of you. So if we want to shift the marginal dollar we're spending, as the government is spending, to try and increase savings, why not scrap the tax deductibility of this and use that $100 billion to shore up Social Security instead? That would, given the redistribution that takes place in Social Security, that's a pretty direct way of helping low-income workers.
Let me start with that.
Sure.
Well, so I think that if you want to continue to cut the $100 billion, I think that's not a bad place to put it. I think that Social Security and private savings are solving different problems. I think Social Security is, as the Secretary mentioned, is especially important for lower income households. And for the more middle class households, it provides kind of the bedrock of financial support, but it doesn't provide all that they need. I think private savings are about filling that gap between what Social Security provides, which is maybe, for the middle class household, something like 40% of their working life annual income, and brings it up to something more like 70 or 75%, which is what we think they need to maintain a standard of living. And so it's not. I don't think that that's necessarily a bad idea. It's just kind of attacking a different piece of the problem.
Yeah, Melissa, let me just jump in, because I think it's very important that you raised Social Security in this discussion, because I think that in looking at retirement savings and public policy toward retirement saving, it's actually important to integrate over all of the programs that deliver potential benefits for retirees. And that matters both for thinking about the levels of resources available, as John has said. It's not just the quote lower income tail that benefits from Social Security. I mean, it's up toward close to the median of the distribution of retirees are relying overwhelmingly on their Social Security income in retirement. So one cannot think about retirement security in the U.S. without focusing absolutely centrally on the role that Social Security plays. And I think injecting into the discussion what is the appropriate level and the appropriate progressivity of Social Security is something that we really do have to have on the table as we think about this. I think of the Social Security system as partly a complement to what we do on the private side in terms of the retirement savings incentives, right? The Social Security system is progressive enough that for those at the upper tranche of the wage distribution, their lifetime taxes to the system are likely to be larger than the lifetime benefits they receive. And partly when you marry that with a tax incentive structure where the tax benefit is larger for those who are higher in the distribution, these two things taken together have a different distributional profile than if you look at either one by themselves. So I think it is important to do that integration. Second point is, I think that Social Security and the private saving in many ways, they do solve related problems, but there's an important distinction between the two. Social Security is an annuity. It's a wonderful annuity. It's a real annuity. It's an indexed annuity, right? So it's providing a floor of consumption that is really important in longevity insurance. And anyone who's looked at the annuity market and tried to understand why there isn't more demand for annuities in the US, the first key fact that jumps out at you is when you start out with a floor like Social Security, even though it may not be the floor that anyone in this room would like to be living on, it does bound the lower level of your consumption well away from zero. And that's important. And it reduces the demand for the private annuity market significantly because we have that market operating. The one thing it doesn't provide is a sort of financial resilience in the event that you have an immediate need. And of course, this is the connection between this panel and the previous one about long-term care needs, because you can't borrow against your future Social Security, and you can't meet an immediate medical bill or a need for a short-term spell of long-term of care if you have only the Social Security annuity. So the role that the various private saving instruments may provide is to build up the nest egg, which can be used in the event of one of those kind of financial calamities, which of course we know from the discussion of insurance markets, the calamities are rare, but they happen surprisingly frequently when you look over an entire lifespan for someone. So, what in some of the work on drawdown of retirement assets has suggested, and I think there was often a great concern in the defined contribution space that those who had built up these accounts would reach retirement and they'd immediately run for the exits and pull the money out and spend it all. And by the way, whether we can generalize the experience of today's retirees with DC plans to what it's going to look like in 20 years when those plans are going to have affected a much larger part of the population is unclear. But at least for the evidence we've got so far, it doesn't look as though people race for the exits. In fact, their financial assets often are drawn down very slowly during their late 60s into their 70s. And it's when you get to the 80s that we heard about in the last panel, when all of a sudden, death of a spouse or a major illness or a need for some long-term care kicks in, then you start to discover that the asset profile takes almost a shift downward, and you start to see people running down their assets. So I think that a lot of the research on the life cycle model and understanding the accumulation and drawdown of assets has moved from thinking that we're in a world of smooth labor income and smooth consumption while you're working and also while you're retired, to thinking that we've got the variable labor income up front and you're trying to build up a nest egg that both insures against fluctuations there, but then gets you a balance which once you go into retirement, your day-to-day needs may not be that great, but there might be times when you need a lot of assets to cover some short-term need. If you're not going to rely on the public social insurance system, which in the case of medical care would mean Medicare plus Medicaid, if you want to cover some of that yourself to be able to purchase care, which is more expensive than what those programs might provide in various ways, then you need to begin to think about the accumulation of retirement assets. And that's, of course, where the private system starts to kick in.
Debra, did you want to jump in?
Sure, because nobody loves Social Security more than AARP. And so we would take your money and make it sustainable. I think it's we have to make that program work. For the vast majority of the population, this is their major source of retirement security, and we can't do #retirement security without it. So we need to address the long-term budget issues within the program and do it sooner than later. That said, Social Security is not enough. I completely agree with Jim that whether it's for those really big expenses like a long-term care or somebody getting dementia, or the small expenses like your car breaks down, the average benefit of $13,000 a year is not enough to live on, and so people are going to need to save for their future. And that's why we need to be working on both sides of the income scale, and that's why I applaud these types of proposals, because I think it brings attention to the fact that the current system is not working for a lot of people. Half of the people don't have a way to save through their paycheck. That's the easiest way to do it. And we need to make sure that more and more people have that opportunity.
So I'm going to, you mentioned the car breaking down, which of course makes me think of precautionary savings, or like how hard it is for an average American or a lower income American to come up with $2,000, right? We know these statistics and they're frightening. But that leads me to think that for low income folks, maybe many of them shouldn't be saving for retirement. They're going to be relying on Social Security. They're going to be relying on Medicaid. There would be a real benefit to them and their families for stretching a bit to move to a safer neighborhood, to buy healthier foods, to maybe have some extracurricular activities for their kids. I mean, I know this is heretical and like this retirement crowd, but maybe we don't want everyone saving more for retirement. Is there anything like?
So I don't think saving for retirement should be the only thing you save for. Let me just be clear. I think there's lots of things to save for. I'm putting money aside every month for my 2 kids' future college, and my son is 10. I also put money aside in case my car breaks down on a given week. We should make all types of saving easier, and we don't. And I think we can build on the system we have, especially with movements in the financial markets that make it more easy to add to different account structures. And we should be building up a saving society. That said, retirement is a special time in which you are less likely to be physically able to work and to make up any needs that you can by picking up an extra job. And it's probably going to be a longer span, and so we need to build up for that in the same way I'm building up for my 10-year-old's future time at MIT working with Dr. Poterba.
So, Melissa, I will join you in walking out on the heresy plank here. I think that if you say we are all trying to encourage saving by the lower and lower middle class, it sounds like a laudable goal. If you describe it as we'd like to reduce the consumption by the already stretched middle class that has seen very slow growth in living standards over the last few decades, it sounds like a less attractive thing to be doing. So I think we do have to trade off these issues of how to think about providing life cycles worth of consumption support with the available levels of resources. Some of this invariably is, if we're trying to bolster the lower and the middle class folks, may involve more redistribution on a lifetime basis, and of course that happens to a significant degree within Social Security at the moment. So thinking about not just the level of funding, but also the shape of that benefits versus tax profile is something that needs to be on the agenda. I think the other thing with respect to the financial security, not just of retirees, but the broader American households, you mentioned how many people can find $2,000 on short notice. At least if my family's experience with how many times we need $2,000 to fix our cars generalizes to the population. If as many people as say they couldn't find the $2,000, it really couldn't, there would be cars abandoned on the roads everywhere. So I'm not sure what the answer is, and again, if my experience generalizes, it's the intra-family transfers that may go on, and when the actual moment comes along, it turns out that there are informal capital market devices that provide some support for these folks that they may not be thinking of when they answer the financial availability question. Right? Yes, I don't have $2,000 in the bank, but there are family members of mine who don't. But if they needed $2,000, I know somebody they might come to, and the $2,000 would materialize when they needed it. So I think, to be honest, as a research matter, I'm not sure that we fully understand the financial circumstances of those who are in the lower, maybe it's the lower third or something like that. But I think that there are informal networks that may work more than we think. Now, if the answer is that these folks go to extortionary lenders and do it, then in some sense we really do want to try to solve this problem, because that's not a great place. But if the answer is that there's a short-term lending market that operates at very low interest rates they can draw into, it may be a different story.
And I think the payday lenders, which are taking trillions away from low-income people, is an example of where not everybody has friends with or relatives with capital, and so we can do that better.
Can you said on this? I think that this discussion about whether all people should be saving is a great example of where I think firms can play a really important role here. So, for instance, in my proposal, right, it's not that low-income people can't save; it's just that we're not going to hit firms on the head to make them save, exactly because we think that, there's a greater chance that they're going to need that money today. But I think that there are all sorts of different circumstances that you can imagine firms having a really great sense of parts of their labor force that really could use to be saving a lot more, and firms, workers in the labor force that might not need to be saving enough. So just to give you kind of 2 examples on the extremes, right, I work with a lot of graduate students at Brown University. They get paid as teaching fellows. They would make enough so that in the population as a whole, we should think they should be saving, but we know that they are in school, and they are working hard to support their families in advance of leaving school, and we hope making quite a bit more money. So that's a population where maybe like you exactly want Brown University there to say, hey, like maybe these individuals don't have to be saving. On the other hand, I saw a wonderful interview on TV with a man that ran an oil services firm in North Dakota. And he has a bunch of employees that make hundreds of thousands of dollars a year in a business that kind of everybody knows is cyclical. And he talked about how he works so hard to get his employees to save because he knows that, maybe it's 2 years, maybe it's 5 years, but at some point, kind of the carousel is going to come to an end. And that's an example where even, comparing to other people, you'd want your employers to say even more. And I think that's exactly the type of flexibility that keeping firms kind of in the game really facilitates.
Okay, so I want to talk about the broader shift away from defined benefit plans to defined contribution plans, and the consequence that this means individuals have to make more of these decisions, complicated decisions, not just how much should I save on any given year, but where should I save and what kind of savings product should I be putting my money into. So what do we know from the research based on this in terms of how prepared people are to make these decisions and effective ways of guiding individuals into what appear to be the sort of best types of savings accounts for them?
I think the literature on defaults working shows that having a clear runway is probably the best thing.
In some sense, that takes the decision away from them.
Which takes the decision away from them. And you mentioned, what to save, what amount to save, where to save it, by who's the provider. And that's one piece I didn't understand from yours. If the individual has to choose their provider, then it's now the busboy that has to figure out if it's Fidelity versus TI-CREF. And that's a whole other level of complication that we don't have today. But workers, have to decide, if they're going to increase it every year and how much to save over time. And we've sort of automated some of those, and I think there's really good ideas within this proposal to make that more universal. The really tough decisions come when you retire, and we've pretty much not talked about that at all in public policy, because then people have to say, okay, I've done everything right, I've saved all this money. How much can I take out each month? And in order to do that calculation, and Jim may be able to do it, you need to know future interest rates, and actually Bob might know that, future rates of inflation, how long you are going to live, as well as how long your spouse is going to live. And if you can calculate all of those things, then you know how much to take out each month. And that's the piece where we haven't automated, and we haven't really developed as many products beyond annuities that, as we know, most people aren't buying, in order to make those decisions easier. So I think on the how to save, get an employer to auto-enroll you into a program into higher than 3% with auto-escalation into a QDIA, and we've got a lot of those types of decisions made, but we haven't really talked about what DB helped you with was that paycheck every month, and we're not doing that at all with DC.
Yeah, I just want to second that general theme. I think that we know that many workers really don't have the tools or the desire to try to work through these problems, right? In an audience like this, I wouldn't ask for a show of hands, but my guess is many people have done, should I do a Roth versus a regular IRA calculation, and even enjoyed doing it to see what the answer was, right? That is not representative of the U.S. population. Right? Most people are terrified of doing arithmetic, leave alone compound interest and exponential growth. Right? So, fundamentally, and the example of this, which Debra's point makes, is the difference in what you should be saving to ensure retirement in today's low long-term interest rate environment versus the higher long-term interest rate environment 10 years ago or even 6 years ago is dramatic. But you don't see people focusing on that as a first-order problem to think about, and you don't see lots of responses to people. Second thing to know is, I think when we have defaults and we have something which either the government has provided or the employer has provided, I think a lot of the plan participants assume that the default has been designed to be optimal for them. And they assume that they don't really have to think much about this once the default is in place. And that's why, for example, the 3% default as a contribution level is something that disturbs me, because I think once it's there, you get a tendency for people to say, well, somebody who understands this all has figured out and made this the default. And in fact, if the default emerged from the employer deciding that this wasn't going to cause much pushback from the workers or raise much risk on the fiduciary standard or whatever, you may not have the, quote, right answer for many of the workers. And of course, that's why we saw money market funds as a default for a long time in 401k plans, even though very few financial planners would have said that that was the right solution for anybody to be investing their retirement assets in. So I think that when we are in a world where we tend to rely on the defaults, it does put a lot of pressure on the policymakers and the regulation writers to come up with safe harbors that are, they're going to have to be one size fits all to some degree, but that are pretty good sizes as we do it. And it also puts burdens on the employers to come up with things which are going to work for a large fraction of the group.
Great. Great. So before I start asking some of these questions from the audience, I want to know if there's lessons we can learn from innovative things either the states are doing or other countries.
Yes. I'm so glad you asked. Like Tom Perez, I am thrilled and so excited about what's going on in the States, because this is real progress. Many of the people in this room who I'm looking at my friends that have been toiling in this space for years and decades have not seen the type of progress that we're seeing in the last 12 months over the last 20 years. And for those of you that didn't catch what Secretary Perez was talking about, it's that 21 states are really thinking about this issue of coverage. And how can they make sure that all of their workers who don't have access to retirement accounts have access? And it's just sort of filling the gap. They're not going to muck with the current system, but for employers and workers in those businesses who can't save through their paycheck, they're coming up with different ways. And this is true laboratories of democracy type stuff that just get all of us so excited, because there's no one plan. Every state's sort of taking its own flavor. Washington State has a marketplace approach where they're going to have potential providers that can offer low-cost plans to their workers. We have studies of different plans, and we see Kathleen Kennedy Townsend. So I want to give a shout out to my home state of Maryland, who's considering this. California is looking at it. We even have West Virginia considering these types of plans. And then we have places like Illinois who said, we're going to set up a 529 type plan, because we already have one of those, where we are going to collect the funds and have it privately managed. So what's exciting to me is that this will create, mostly for people in small businesses, that ease of where they don't have to decide what's best, but they have a place to go, either through the state in some of the states or to a preset marketplace. The system designs are not ideal because the states are trying to avoid ERISA. And all of that responsibilities. Many are at contribution levels of about 3% with caps. They're using IRA structures. There's questions about fiduciary responsibility that need to be addressed. There's efficiencies that need to be addressed. So I think it's a very important step forward of the governors. That is true. I must say, for Kathleen's sake, she wants to be under ERISA. Many of the other states are trying to avoid it like the plague. But I think this is a major step where governors are saying, and they're looking at that last conversation that we just had, what's going to happen to my future Medicaid costs and long-term care needs, and how can I help my workers prepare for those? And governors or treasurers are taking this on as a piece of their responsibility. I would love to see, again, a federal response, and there's bills by the administration. A shout out to Brookings, Mark Avery, and David John, who have auto IRA proposals and that the administration has adopted. These are the types of things that we need to think about, but the states are actually moving. They're passing bills. They're actually going into enactment. They are really studying it, and I think that that's thrilling.
This is about the 6th event in a row at Hamilton where we were talking about things the federal government isn't doing, and so the states are moving. We just had infrastructure, and this came up last month, too.
Let me just say, you asked about international evidence, and I think that there, again, we can learn. Although sometimes the countries seem to be moving in different directions, right? The US seems to be making it easier for people to annuitize within a defined contribution setting. The UK has just removed the requirement for annuitization in their DC plans. So, but that of course gives you the variation, a little bit of the laboratories of democracy. One thing that some recent work by David Laibson and Bridget Madrian and James Choi and James Bashirs has pointed to is the leakage issues and the degree to which people are able to get at the plan assets across countries. And there, the US is actually, I believe, relatively far toward the easy access to retirement account end of the distribution. Other countries tend to make it much more difficult to do pre-retirement tapping of these accounts. And I think that's something where, frankly, we ought to be thinking a bit because once you've managed to surmount the hurdles that John is trying to tackle in this project and this proposal, which is to get the money into the accounts, if you then lose it before you get to the point when it supports retirement, obviously there could be financial hardships along the way that would make it, just as your earlier comment suggested, quite appropriate to take the funds out. But if you can keep it in there, it seems like you fought most of the battle by getting the contributions in the first place, and you'd like to try to push as much forward as you can reasonably do toward retirement.
Great. Okay, John, here is a very specific question for you. What is the rationale for moving the regulatory authority from ERISA to the Treasury Department?
Sure. So, I think that what I try to do is think about this, how we would set this up if we were starting from scratch, and then work backwards to what's feasible from the current position. And I think that the fiduciary responsibility that would be provided is, again, it's primarily a financial responsibility. It's, again, very similar to what we require in some other settings. It's a higher bar, but it's a similar set of questions to what we ask of mortgage interest contracts or credit cards or bank accounts or debit cards or things like that. And it just seemed natural that for a primarily financial question like that, we could locate it with other people, places that are making financial decisions. The point is not that the Labor Department is currently doing a bad job of it. I think they're doing a great job of it, and as we saw today, they're continuing to kind of press this forward. But as one moves the locus of this, of the fiduciary responsibility itself away from firms and towards financial account managers, it seemed, again, it seemed more natural to kind of move the regulatory authority along with it.
Great. Satisfied? I'm not seeing anyone arguing, so I think that was good. Okay, so someone... No, this is not democracy. Okay, so someone wants to bring it back to Social Security. Why is lifting the cap on Social Security contributions so politically difficult?
One of us has
Oh,
worked
did you
on the
mean
Hill.
at the panel? I thought you meant in the room.
I did.
Oh.
You shouldn't be taking votes. You should be.
Yeah, exactly. Okay.
Well, I don't think it's that one proposal. I think Social Security, you can't just do one thing for Social Security. I think it has to be a broader discussion, and Congress has not wanted to have that broader discussion about ways to make it solvent and quite frankly, modern for the future. It was designed 80 years ago. We're about to celebrate the anniversary, lots of candles. And I think it was designed for a different population. So we need to have the conversation about what's the right Social Security for the future. And just one change to it, changing the coverage of what income is taxable, isn't going to be the only debate that Congress will want to have. And so I think it's going to be a broad battle and discussion about that program as the foundation of retirement security. And as I said, we couldn't get small little pieces that deal with leakage passed in Congress. I think we need to have the laboratories show the way and show ways to improve the system that'll push not just retirement savings, but hopefully a long-term, sustainable, solvent Social Security program that's designed for the future needs of our population.
You know, I think one thing that is important, and I hardly want to handicap the politics of this, but I think that many people still operate with the view that we have a three-legged stool of retirement support that relies partly on Social Security, partly on private saving, and partly on the employer-provided, pension structure. And when you look at the reality for retirees, what you discover is that for close to half of them, this is really a 1.5-legged stool, where the half is that they have home equity built up in their houses, and they may or may not ever tap into that as they go through the retirement years. But close to half of them are not going to be provided for in the current structure by an employer-provided pension account of some sort, or by much in the way of private saving, because they just haven't built up much financial assets outside their home equity. So to me, once you recognize that fact, it really is transformative in terms of the way you have to think about Social Security, because it's telling you that for close to half of the population, what you're doing with this program is largely determining what retirement consumption will be like for that group. And then, as you work your way up the distribution, the three-legged stool, in fact, becomes a four-legged stool, because you have both retirement savings through an employer plan, and you have private saving, and you have home equity, and you have Social Security. And then, it gets much more complicated. But the simple reality of retirement support for this bottom tranche is really that it's about Social Security at this point.
Right. So our focus of the discussion really has been about individual security. And this question takes a macro view and asks, would there be important macroeconomic consequences if households saved more, and what would they be?
So I think there would be some. So in the projections that I did, I get something like another $50 billion a year of savings as a result of the increased savings from this plan. So that is a lot from the perspective of providing retirement security for middle-class households. But from the grand perspective of the amount of capital that we have in the country, it's not an enormous amount. And so I think of this as certainly a pushing in the right direction in terms of macro growth, but I don't think that it by itself would solve our macro growth problems.
Jim, do you agree?
Yeah, I think there are two pieces. I mean, where I suspect the questioner is headed is, wouldn't increased saving mean less aggregate demand in the short run, and a very simple Keynesian-style analysis saying, wouldn't that weaken the economy if we had more saving? And to some degree, I suspect there is an effect along those lines. The countervailing force is that over the longer haul, you do, as a result of getting more saving, you get favorable effects on capital accumulation, potentially lower interest rates. In a global capital market, of course, those things are rather diffused, but you are providing for more consumption later at the cost of a little bit less now. I think the other thing, frankly, is that, and this came up in the last panel as well, strengthening the private side of support for retirement, although not in a way that you could count the numbers right now as you think about any budgetary sense, but providing a stronger private side probably, in fact, allows you to spend less government money in the future in providing retirement security or long-term health security. So while you wouldn't, no one would score that for you in one of these proposals, I do think that if we had a more robust private sector savings where you didn't see that the private sector savings started above the median, you might be able to do different things in public policy down the road, which might be attractive.
And I will point out, CBO would score additional savings as a cost of decreased revenue. So because of the 10-year budget window, they're not going to catch the additional revenue that would come later. And so that's why Congress has been using a lot of Roth conversions as a way to fund transportation or do all kinds of other things.
Great. Well, this has been a wonderfully thoughtful conversation. So thank you to all our panelists and our author.
To be presided over by Melissa Kearney. And Melissa has done a fabulous job, and we are deeply, deeply grateful to her for what she has done. She is going to remain involved with us in some fashion or other as she goes back to her teaching duties at the University of Maryland, but we're going to continue to have an ongoing working relationship. Diane Whitmore Schatzenbach is coming to us from Northwestern University. She is also a research fellow at the National Bureau of Economic Research, which is at least a moderately respectable thing to be, I gather. At least that's what I'm told, mostly by its director. And we look forward to her joining us and then carrying on our work. So, Melissa, we thank you, and you've been terrific.